Hello, this is Josie Harris-Walton with Coleman & Walton Law Firm. So you started your business and you're saying, what do I do? What entity structure do I use? So today we're going to talk about entity structuring and tax consequences of those entity structures. So let's first talk about the different entity structuring. So the first one we have is you could be a sole proprietor, and a sole proprietor is where you are actually commingling with your business. Pretty much you don't have an EIN number, you haven't registered with the state, and you saying, okay, I just want to start a business. So that's considered a sole proprietor. Now, you say, I do want to start a business. I want to register with the Secretary of State, and I want to be what they call a limited liability company. A limited liability company is where you register with the Secretary of State of Georgia, and you are now wanting to separate yourself from your business. So you open up an LLC. The next one is considered a partnership. You're an LLC, and now you want to add on a partner. So for tax purposes, that's considered a partnership. Two or more individuals, owners of a company is considered a partnership. The next one is an S corporation. An S corporation can be an LLC for state purposes, but you have to register to be in what they call an S corporation for tax purposes. So that's an S, what they consider a small business for taxes. And the last one is a C corporation. A C corporation is where you register your corporation with the Secretary of State of Georgia as a C corporation, and you want to be taxed as a C corporation. So those are the 5 entities that we're going to discuss today. So pretty much, let's talk about now the benefits of being these different entities. So for tax purposes, with the sole proprietorship, you're considered an individual, and you only have to file your individual tax returns. So that's one of the advantages that a lot of people like being a sole proprietor, is the fact that you get to file your 1040 and you file what they call a Schedule A. So the 1040 is an individual tax return. Now, the disadvantages of that is you are for asset protection. You're not protected because pretty much you commingle your business with your personal. So let's say if someone was to come, sue you, they could actually sue you as a person and not just your business. So that's the reason why a lot of people set up as an LLC. So let's discuss an LLC. So now you're an LLC, and for tax purposes, you want to know what to do. You will file a 1040, which is an individual tax return, and then you would also file what they call a Schedule C. So the Schedule C is pretty much you take your business income as well as your deductions, and you use them for your personal taxes. So you're still filing your 1040, and you're still filing the Schedule C, but you're also what they call separated from your business. You personally is separated from your business. Now, let's discuss a partnership. So now it's 2 or more partners in the company, and you have to file, individually, you have to file what they call a 1040, and then also you have to file a 1065, which is a partnership informational tax return. So pretty much now you're filing 2 tax returns, one as an individual and one as a partnership. Now, the good thing about a partnership is, for a partnership, you can actually, what they call, pass through your losses to your personal taxes. So so each partner files a 1040, and then they put their losses or whatever from the partnership onto their individual taxes. So that's one of the good tax advantages for a partnership. Now, let's talk about an S corporation. You're an LLC or you're a C corporation in the state that you're in, which is Georgia, and you decide that you want to elect to be what they call an S corporation. So you file this form with the IRS, and they say, yes, you can be now an S corporation. So as an S corporation, it's a pass-through entity as well, but it's considered a small corporation. So you file a 1040 on your own as an individual, and then you also file an 1120S, which is an informational tax return that you file as a business. So you have to file these 2 tax returns, 1120S, which is an informational tax return, and then your 1040. So with the S corporation, which just like a partnership, everything flows through to your personal taxes. So pretty much you can use any losses that you have from your business as an S corporation, it passes through to your individual. So just say if you have, for instance, a a full-time job as an employee, you can actually use your business losses for your personal, which helps you with your tax liability, which minimize your tax liability. Now, to say you decide, I don't want to be any of those entities, I just want to be a C corporation. So for tax purposes, you are totally distinguish yourself from your individual taxes. Anything that goes on a C corporation tax, which is 1120, is considered that business's taxes. So if the tax, let's say you owe zero tax liability for your corporation, you wouldn't, or you have any losses on that C corporation on 1120, you do not move that over to your personal tax. So they're totally separate taxes. So you file the 1040 for yourself and you pay whatever tax liability there, and then you file an 1120, which is the C corporation tax return. And the good thing about a C corporation is that you actually can, the tax liability rate is less. So pretty much the tax liability rate can be about 15% average for a C corporation. So that's why some people will file a C corporation tax return instead of just doing an S corporation or any pass-through entity. So pretty much we talked about today is the entity structuring and what's a tax consequence and what tax returns you have to file for those different entity structuring. Thank you so much for watching this video. If you need to reach me, you can reach me at Josie at LifeForth.com.